Well, good afternoon. My name is Eric Levinson, Head of Business Development for Vena Capital. Today's Wednesday, April 5th, and we are going to do our Q1 review and Q2 outlook webinar for what's going on in Vietnam and the Vietnam market. Now, it's been said that bull markets climb a wall of worry, and that seems to be what we have going on in the first quarter. Now, year to date, or at least through the first quarter, market actually was up pretty nicely. In local terms, up 5.7%, and USD terms, up 6.4%. But having said that, how we got there was a roller coaster. My colleagues Michael and Ismail will speak to that. Now, on the performance side, people want to know, well, how have we done? Well, for VOF, our London flagship fund, year to date or through the end of the quarter, up 3.9 versus 6.7. But again, what we really focus on, we want our clients to focus on is how have we done longer term? 1 year, 22.9 versus 29. And then the 3-year outperformance, 20 versus 19, 5-year, 2.5 versus 0.9. And then VVF, our UCITS portfolio, year to date had a more conservative posture going into the year. But you look at 1 year significant alpha, 3-year alpha of really 10% per year over the last 3 years. 5-year looks good. And VAF, our Cayman feeder, again, consistent outperformance, 1 year, 3-year, and life of the portfolio. And then when we look at our local funds, VEOF, 1 year number more attractive, 3-year number, 5-year, et cetera. VSAF, which has consistently been the top performing portfolio in Vietnam, outperforming year to date, 1 year, 3-year, 5-year. Again, you know, it's not one portfolio or one member of the team that's outperforming. We really are very proud of our investment team kind of across the platform and what they're able to deliver. Now, first quarter, as I mentioned, has been quite challenging. We've recently seen some GDP news that was a little bit less positive than we expected. You may have seen the headlines as well. So with that, I'm going to turn it over to Michael Kokolari, our chief economist, to explain what's going on in the economy and why we still remain cautiously optimistic. Michael?
Thanks, Eric. Okay. So, as Eric mentioned, or alluded to, the GDP growth in Q1 of 3.3% was much lower than we expected. Now, that having been said, the dynamic of how GDP is working this year is kind of what we expected and what we discussed in our webinar back in January. And so that dynamic, just to review, is that this year, Vietnam's economic growth is being negatively impacted by a slowdown in the demand for products that are made here, made in Vietnam products. And the demand is slowing primarily in the US, so this is the kind of thing that's weighing on the economy. And against that, the economy is being boosted by the tourist arrivals coming back. So those are kind of the two main factors that are weighing, going in opposite directions. And then the other factors to mention are that we've had a reasonable pickup in infrastructure spending, which is helping to support the economy somewhat, but it's not really as much as what we were hoping or what the government was guiding earlier in this year. That's another factor. And the other thing is something that we have discussed in both our webinars, and we've published some reports about this before, is that the real estate market in Vietnam is quite frozen at the moment. So those are the main kind of dynamics of what's happening this year. The rest of my presentation, I'm going to go a little bit into the details of all those different factors. Before I do that, though, let me just say, and what we think the government is doing and could do to help support the growth for the rest of this year. But before I start delving into the details, let me mention a few things just right up front. And the first thing is I mentioned that the real estate market is having a negative impact on the economy this year. And I want to say something right now, and I'll get more into the details later, which is that Vietnam is absolutely not in a situation of there was a real estate boom and now we're in the aftermath of the boom. That's not our current situation. There's not nearly enough apartments that are being constructed in Vietnam every year for all the number of people that want to buy them. So we're not in a typical emerging markets kind of boom and bust cycle. And I'll talk a little bit more about that in a second. So that's the first thing. And the second thing is you probably know that the State Bank of Vietnam cut policy interest rates last week, actually. And this is kind of the first move that we see the government doing to try to address the slow Q1 GDP growth. And we'll talk a little bit more about some of these other things that they could do and hopefully will do as the year progresses. So that's an overview of everything that I wanted to say. On the next slide here, this is a slide that we first showed back in our January, our predictions for this year. And what I've done is I've tweaked and updated the predictions based on the Q1 figures. We were previously predicting 6% GDP growth. And now we see that at 5.25. The main reason that we've lowered the GDP growth forecast is because now, before I was expecting manufacturing was going to be kind of flat this year, and now we see that it will probably decline. That having been said, the consumption is still fairly resilient. You see it was quite a strong number in Q1. That's partly boosted by the tourist arrivals, by the way. So this is the main thing that we've lowered. We've also lowered a bit our expectation for infrastructure construction based on what happened in Q1. So this is kind of the numbers that equate to the introduction that I gave. And with that said, let me get into more of the details of all these components. The first thing is that tourism arrivals are really shooting up like crazy right now. So you can see right now we're above 60% of pre-COVID levels for tourists coming back. And this is really without there being a substantial return of Chinese tourists yet. Chinese tourists coming back to Vietnam has been impeded by a few things, including some visa issues that we expect will be sorted out probably in the next 1 or 2 months. And also, we also expect that the government will make it easier also for tourists in general to come to Vietnam, make the visa a little bit easier. And so you will certainly see these numbers continue to go higher as the year progresses. So this is previously foreign tourism used to contribute about 10% to GDP. So when you go from around 0 to like 60, 70%, you can see that makes a big positive for the GDP. So that's the thing that's helping to support growth this year. And as I mentioned in my introduction, the biggest thing that's weighing on us is that our exports and therefore our manufacturing activity is really falling. And the reason it's falling is because the demand for products that are made in Vietnam has really dropped. And basically, most of the stuff we most of the stuff we manufacture here is exported, and a lot of it is to the U.S. You can see here that last year the exports to the U.S. were growing, and now they're falling. You can also see that exports by other Asia, big exporters in Asia, are also dropping. In fact, dropping at even a faster pace than they are in Vietnam. So why are exports to the U.S. dropping? Well, the main reason is because last year, companies in the U.S., retailers like Walmart, Nike, Walmart, Target, and also companies that we would call consumer-facing firms like Nike. Nike's not really a retailer, but they sell to the consumers. Companies that sell to the consumers, they have too much inventory last year. Okay, so you can see that towards the middle, maybe a little bit the end of last year, the inventories of these kind of firms were up over 20% year on year. And so what's happening now in the U.S. is that those firms that have too much sneakers, too much furniture, too much iPhones, they're running down their inventories. And since they're running down their inventories, they don't need to give new orders to factories in Vietnam. And this is basically what's happening right now. On this chart, you can kind of see the progress that those firms are having in kind of running down their inventories. Obviously, we're not U.S. economists, but we do some of our own calculations, and we follow other people who are quite smart on this topic. And we see that probably in the second half of this year will be when the inventories in the U.S. have fallen to a sufficient degree that you'll start to see a rebound in orders for factories in Vietnam. Different industries will probably peak and bottom out at different times. What we understand about the garments industry and also about footwear is that their inventories are probably not likely to bottom out until towards the end of this year. So factories in Vietnam that make those kind of products probably won't see their orders rebound until towards the end of this year. But on the other hand, factories that produce furniture, for example, it seems like that inventory cycle has sort of started to bottom out in the U.S. And then things like electronics will probably bottom out in the middle of the second half of this year. So that is the explanation about why manufacturing is getting hit in Vietnam and why exports are getting hit. From here, I'm going to go into kind of an interesting side topic that will turn out to be important later in this presentation, which is that Vietnam's trade surplus is actually getting better this year. So that sounds kind of strange, right after what I just mentioned, that the exports are getting hit, U.S. consumers are not buying as many made in Vietnam products. You'd say, well, wait a second, how can your trade surplus be getting better? And by the way, the trade surplus getting better is also supporting the value of the Vietnam dong. So here's the story about that, which is that most imports in Vietnam are done by FDI factories. Most imports in Vietnam are done by firms that they import production materials. So when they're going to make like an iPhone, they import all the components used to make the iPhone, and then they use the labor here to assemble the product, and then they export it off to the US. And so what we're seeing this year is that imports are dropping at a faster pace than exports. And you may notice on my slide, I'm catching in real time here a typo because we actually have it the other way around here. It's actually that imports are falling at about a 15% pace and exports are falling at about 12% pace. And so what's happening is that the FDI companies, they're looking at their order book and they're saying, okay, I think when I see the rest of my year, and by the way, those of you that follow in the US, we had the ISM PMI came out yesterday, and kind of the same story there, that the inventories are starting to collapse of production materials. So basically what the manufacturing firms are saying is that, okay, I see my order book is not that strong for the rest of the year, so I'm going to order less of the components I need to make iPhones, make garments, this kind of stuff. And that's the reason that our trade surplus is widening, and that will be important, and I'll come back to that topic in a second. So that's the story about the slowdown in the GDP because of the slower demand for products, made in Vietnam products in the US. The other factor that I mentioned is weighing on growth this year is a slowdown in the real estate sector. Now, the important thing to note here is that what is slowing down the real estate sector is really two factors. The first factor is that the companies don't have enough access to sufficient credit, to sufficient capital to finance their operations. So they have a project that's in progress and they're finding it harder to borrow from the bank. Previously, what a lot of real estate developers did is they issued these 2-year corporate bonds, and the government has put in some regulations because of some things that happened in the past that have made it difficult now to roll over those 2-year bonds, to refinance those bonds. So the developers are finding it a little bit harder to raise financing, and at the same time, the approval process is it's making it difficult for companies to go in and take a piece of land and rezone it for use as like say, for example, from agriculture land to build an apartment if you're in a suburban area on the periphery of a town. These are kind of the two main factors that are impacting the real estate market right now. And then, in addition to that, there's this kind of thing in the background that's always sort of going on in Vietnam, which is what bankers would call an asset-liability mismatch. And what I mean by that is that the developers, they'll go out and they'll buy like a raw piece of land. And so now they have this asset, the raw piece of land. And it will probably take them maybe 6-7 years from the time that they buy the piece of land, that they can go through all the rezoning, that they can actually construct like an office building or an apartment building and sell those units to the final buyers and get the cash for that. So that's a pretty long stretch from the time that they put the cash out of their pockets until they actually get cash back from the end buyer of the product. And so the problem that a lot of developers have here is that they're facing this kind of 7-year time horizon from the time that they buy to the time they get the cash. And they don't really, it's not easy for them to access money for 5, 6, 7 years. So I just mentioned there's this big phenomenon where they were issuing corporate bonds for 2 years and then rolling it over for another 2 years. So this is something that's kind of always sitting in the background. But this year in particular, they have this acute problem, which is the approvals are really grinding to a halt, and that it's harder for them to get the lending. On this issue of the tight liquidity, I'll come back to this topic in a second, but long story short, over the last 3 years, banks in Vietnam, their credit growth has outpaced the deposit growth by about 3 percentage points a year. And so there's been an accumulation of over the last 3 years where for the banks, their liquidity position is getting tighter. So it's a little bit more, it is more difficult for developers and others to borrow money from the banks right now. And that topic is a little bit out of my wheelhouse. My colleague Ismail, the head of research, who's, by the way, a banking expert, will talk a little bit more about that topic, the tight liquidity in the banks, and how it's also affect the stock market indirectly as well. Okay, so that's kind of an overview of the issues that have been impeding the real estate market this year. Again, what I really want to focus on, this is probably one of the most important slides in my whole presentation today, is that Vietnam is not experiencing one of these kind of emerging market boom and bust cycles in the real estate market. You know, typically what happens in emerging markets is they build like a gazillion apartments and a lot of them end up being empty, and that's not the case here. In Vietnam, we are not building enough apartment units, enough housing units for the number of people that want to buy them every year. When you look at the people getting married, or look at urbanization, there's not enough units for normal buyers that are being built. So it's not the typical story of an emerging market. It's also quite different than the story in China. In China, for many years, the government kind of encouraged what we might call excess production of housing units. You may know that the vacancy rate is something like 25% in China. And the reason that they did this is kind of as a way to boost the economy in the short term. So in China, when we look at what they did over those last 10 years, they did a lot of what we might call excess infrastructure construction. There's a lot of roads to nowhere, bridges to nowhere, and they built these ghost cities. And they did that all because they wanted to keep the GDP growth rate high. Vietnam did not do that. So Vietnam's situation in the real estate market is very different than the typical emerging markets, and it's also very different than the China story. Okay, so that's the story about the real estate market. Now, let's talk a little bit about the initial moves that the government has done to try to help support the GDP growth and what we think they could do as the year progresses and probably into 2024 as well. So last year was a year in which the government really prioritized keeping the USD VND exchange rate as stable as possible. And remember that what was happening last year was the value of the US dollar, the DXY index, was soaring like crazy. And so at that time, the government raised policy interest rates. They made it, the monetary tightening, they made it more difficult for companies and real estate firms to borrow. And they did that because they wanted to keep the exchange rate stable. Something I've mentioned in many of my webinars and my reports before, and this is a whole tangent, so I won't spend much time on it, but basically in Vietnam, they generally prioritize trying to keep the exchange rate stable so that foreign investors, both FDI investors and investors into the stock market, will feel comfortable that when they put their money here, they won't like lose it on a quick currency depreciation. So very different than what happened in the Asian financial crisis in 1997, for example. So last year, we really saw that strategy in action, that they were trying to keep the currency stable. But now, because of what I mentioned before, that the currency is kind of naturally strengthening, we're appreciated about 1% year to date, and also because inflation is quite modest, around 3–4%, they've switched from focusing on stabilizing the currency to going back and focusing on reviving economic growth. So the first move that they did last week is they cut the policy interest rates. And again, it was enabled by the dong appreciation, because last year they were hiking to keep the dong stable. Now they don't need to do that. And so what we expect is that this policy interest rate hike will eventually, as the year progresses, help with what we might call a reliquefaction of the banking system. So far, the deposit rates that the banks are paying have not come down that much. They have started coming down, and we think that as this year progresses, you'll see kind of a gradual decline in the interest rates that the banks are paying to savers. But the key issue here is, as I mentioned before, this issue that the credit growth in Vietnam really outpaced deposit growth over those last 3 years. And so this is the main reason that we haven't seen, you see here that the government bond yields have really plunged, but we haven't seen kind of an equivalent plunge in the interest rates that the banks are paying to savers, and that's because of this liquidity problem that will get solved over time, over the rest of this year. Okay, so finally, when we think about what the government can do and has done and will do to support the economy this year, we believe that if deposit rates were to come down by about 200 basis points, so here I mentioned that they've come down about half a percentage point. If deposit rates were to come down by about 2 percentage points, that would be enough to really help revive the real estate market. We also see that although infrastructure spending is off to kind of a reasonable start, we were expecting from the beginning of this year that we would see a much bigger increase in infrastructure spending. One reason we expect that is because the government has ample fiscal resources to spend a lot more money on infrastructure. And by the way, also potentially take other fiscal stimulus measures. That's something we start to hear people talking about. Since they have all this money, why don't they spend it to try to support the economy? So this is something we are hopeful for the rest of this year. And the last thing, as I mentioned, is that we do see, sorry, as I didn't mention, I'll mention it now, is that there has been some relaxation. There were some new rules that were introduced last year about when real estate developers want to issue corporate bonds and to what's entailed in rolling over those bonds. There were some new restrictions that were introduced last year, and recently, literally in the last few weeks, we see some relaxations, a little bit of a rollback of some of those restrictions. And we also see more and more talk, including this week, by the way, that there could be some easing of that will make it easier for real estate developers to, for example, rezone land, to progress with their project, to get the approvals that they need to move forward with their projects. And so these are really kind of real-time developments, the number 3 here. So that is an overview of everything that we see going on with the economy. And to summarize, let me just to recap that, so what's happening this year is that the economy is getting negatively impacted because the demand for made in Vietnam products, particularly in the US, has rolled over and is slowing. And against that, what we see is that the tourist arrivals are really booming, really rebounding. So those are the two things that are pushing growth down and pushing growth up. And the thing that's kind of in the middle so far is the infrastructure spending. It's making a modest contribution to growth, but not yet like a substantial contribution. Okay, so that's everything that I wanted to say. And what I'm going to do now is to hand over to my colleague Ismail, who's going to talk about the investment implications of everything that we discussed and how it's going to affect the stock market and different sectors in the stock market, et cetera. So thank you. All right, turn it over to you, Ismail.
Thank you. All right, great. Okay, continuing on with what Mike was saying. Trying to frame what Mike described for the economy into the market can be, I guess we can say that we're cautiously optimistic for the start of this year. It's pretty much consensus that the first half is going to be quite volatile. And the hope is that the second half is going to be a little bit more smooth sailing. The way we look at this is that the bear market in Vietnam has probably ended. We are expecting that the VNI will be much higher than the 1,007 level that we saw in 2022, notwithstanding the slower global growth and domestic growth that we're seeing. Now, the necessary requirements for this is to instill confidence back in the stock market, and that process will require 2 factors. One is addressing the global issues that the whole world is looking at, which is on inflation. We're hoping that it'll start to moderate. That in turn will hopefully lead to the Fed and other global central banks to start taking a less aggressive stance as far as monetary policy is concerned. And our hope that we do avoid a deep recession. All of those factors will hopefully lead to a risk-on mode that will hopefully benefit Vietnam. On the domestic front, the one line here that we say here is a sense of calm settling in. And what does that mean? It actually just means that let's keep that noise to a muted level. And the noise is coming from the anti-corruption campaign. It's coming from the worries about the sizable corporate bond payment that's scheduled for 2023 and 2024. It's also worried about the real estate developers, which Mike touched on quite a bit earlier. Vietnam itself, though, continues to offer value and growth. It has always been a cheap market. It has always had strong growth, and that has not changed the storyline. We'll go into that in more details later on. The foreign investors have started coming in since the fourth quarter last year, and we continue to see them into this market leading the charge. In terms of positive inflows, it's in sharp contrast to the negative outflows that we're seeing in ASEAN, not just in terms of last year, but also for this year. And finally, as far as ADT is concerned, it will be healthy, but it's probably going to be off from the $750 million average that we saw last year. Mind you, last year, it was boosted by the first quarter, where it was still quite buoyant. And then as we went through the second, third, and fourth quarter of 2022, it started to taper off because of all those uncertainties that we just touched on earlier. On this next slide, we talked about some of the risks in the market. The first three, I would say, are domestic issues. Let's start with the anti-corruption investigations and arrests. We don't think this thing will stop. It will continue. In fact, that campaign has been going on for a good part of a decade. It's just that for the past year, it had become more vocal, a little bit more louder, and that has actually created some unsettling issues for the market. The corporate bond refinancing, as we mentioned, Decree 8 has been passed, and that's going to, I guess, kick the can down the road in the sense that the pressure on asset quality for the banks, the worry about real estate developers not being able to service their debt, it's been now pushed out to about 2 years. It's still an issue that needs to be addressed, but it does buy the sector some time. At the same time, it allows some flexibility. You're now allowed to do some debt-to-asset swaps, which had not been allowed before. So again, that alleviates some of the pressure on two of the biggest sector, which is the banks and the real estate companies. And then the higher domestic inflation. With the interest rates being cut down, oil prices going higher, we have to admit that there might be some pressure on the domestic inflation front. We're running at a very low rate at the moment. We're probably averaging about 4.2% for the first 3 months of the year. We had a fantastic 3-point-odd% in March, and so it looks quite low. And as Mike said earlier, that gave impetus for the SBV to actually cut interest rates, and that hopefully will stoke up the economy, given that 3.3% number was a little bit below expectations, which was hovering around 4.5% for the first quarter. The last three are all exogenous risk. The persistently high U.S. inflation. We are seeing it come down, but again, with oil prices going higher, we have to be guarded just in case there's some trickle-down effect as far as the number is concerned. The strong U.S. dollar. The simple equation behind this is the fact that a strong U.S. dollar is never good for emerging markets, and that includes Vietnam. Right now, Vietnam, the VND is up 1%, and we do expect that can be maintained. If that so happens, then again, that should hopefully translate down to a better stock market for us here. And then the geopolitical tensions. Again, the myriad of tensions can be entered from the Russia-Ukraine situation, China tensions, could even include the oil with Opec. All these things are factors that we have to consider. Some might even say that the banking crisis as far as Europe and also in terms of the U.S. was concerned, what we saw with Credit Suisse and SVB are things that we have to look out for. So again, we have to be quite wary with regards, or at least guarded, that these things can create a little bit of a monkey wrench in terms of our outlook. Now, as far as investment themes concerned, we've been running with several concurrent themes for many years. There's, I guess, 5, I would say even 6 or 7 that we didn't write down. But the one we want to emphasize is domestic consumption and infrastructure. Recall that domestic consumption accounts for 2/3 of domestic GDP. And so in that sense, that is going to be something that will keep going for many, many years to come. Some of the sectors that we do like as far as that play is concerned is aviation, banks, brokers, consumer discretionary, and real estate. The infrastructure, even though Mike is a little bit guarded, pulling it down to about 5% to GDP from a higher number, it will still come through. And aviation, with new airports being built, industrial parks, more companies coming in, setting up shop, materials, whether it's going to be cement or steel, the real estate sector and utilities, those are the ones that will probably benefit from improved infrastructure. Some may even talk about the lower rate beneficiary. Yes, they are coming through. It's not necessarily translating yet to the bank lending rates, but We will expect a little bit a more meaningful drop later on, but at the moment, it's something to keep in mind. And FDI consolidation is something that keeps running on for perennial years to come. So the focus for us this year will be domestic consumption and infrastructure. Again, touching back on what Eric alluded to earlier, it's been a roller coaster ride as far as the market is concerned. For the first quarter, my gosh, it's just been moving between 1020 to 1070. It seems like the market inches up bit by bit. So it hasn't had a big spike, nor has seen a big drop. But in the end, we've seen a 5.7% gain in VND terms, 6.4% in US dollar terms. The US dollar performance is actually one of the best in all of Asia. Only Taiwan and Korea has actually beaten Vietnam's performance in US dollar terms. So again, the 5.7% even in local terms and also 6.4% in US dollar terms, it beats all the ASEAN peers at this point in time. As far as sector performance is concerned, you can see that the best performers have been the energy sector, non-bank financials, the banks, and materials. The laggards have been the consumer staples and consumer discretionary. A lot of the companies that we cover, what's going to be Mobile World, DigiWorld, PET, and so forth, have been guiding numbers down in terms of sales. So again, that's something that we have to acknowledge. But as far as contributions concerned to the index rise, the banks is a key. You factor in that 12% gain with their weight of about 37.5% at this point. You throw in also the non-bank financials, another 3% with that performance. And the financials have been leading the charge for the VNI increase for this year. Now, when you take a look at what I just mentioned in terms of the sector performers, again, non-bank financials, materials, energy, and banks, it is interesting that these sectors actually have the higher beta. And one would tend to think that perhaps the investor sentiment is actually more risk on as far as Vietnam is concerned. And if that is indeed the case, then it is reflected in the fact that the VN30, which represents the large caps, have been leading the index higher with a 6.8% gain, while the VN mid-cap is just flat, down by slightly 0.2%, and the VN small cap, just trailing just a little bit at 5.5% versus the index rise of 5.7%. But again, it feeds into the notion that maybe there is a risk-on mindset as far as sectors, or as far as Vietnam is concerned, and the sectors that have higher beta might be the way to focus. With that, the investors, the foreign institutional investors seems to have recognized the buying opportunity presented by the Vietnam market. Whether it's going to be cheap, whether it's got growth on offer, they now account for 12.3% of average daily turnover. To put that in context, back in 2021, when we had that fantastic bull market run, that number for the foreign investors were only 6%. So we're more than double that number already. So at this point in time, with all the net foreign buying, the foreign institutional investors have been leading the charge, and we expect that to continue still. If you take a look at the ownership levels also, on the back of that, they've now picked up to about 18.5% of ownership on the Ho Seng Stock Exchange. We had dipped down to as low as 16.8, 16.9%, but a nice little recovery, but well off the 21% that we saw many years ago. So still some ways to go. Now, we alluded to the idea that value is an offer. As we mentioned, it's always been a cheap market. We're trading about 10 times equivalent to a developed market like Singapore. Emerging markets should be trading higher. And you can see that the PE discount for ASEAN has actually expanded to about 30.3 to the TIP basket and about 26% to the ASEAN 5. And as far as the historical context concerned, the VNI is closer to the 2 standard deviation below their mean. So again, the whole point behind here is the market is cheap. Now we look at the growth. The one great thing about Vietnam is it's steady, it's resilient. You see this in 2022 to 2024 numbers. It's averaging about 16% growth. We don't have that yo-yo in terms of a 17% loss and 17% gain. I think the stability that Vietnam offers is one of the allures that investors come to love about this market. And in that regard, for 2023, we see aviation, ports, property, brokers, and materials. They're the one leading the charge for this year. Having said that, these were also the sectors that posted the biggest contraction in 2022, so that low base effect is now translating to that nice strong rebound. Now, in terms of the ADT, we touched on this, how we think it's still going to be relatively good, well off its peak, but the importance behind that is earnings growth in terms of philosophy tends to lead markets higher. And that's why we kind of look at the earnings on the other table there, the net profit growth coupled with the beta, because once you get the confidence liquidity, which is typically still conducive to rising markets, that will probably be the focus for most investors. They're going to want to look at what sector is going to have the higher beta, which sector is going to have the higher growth. You couple that together, and we think that's will get the renewed interest back to the market, which will lead to higher ADT. The correlation or relationship between ADT and VNI is quite pronounced. It's quite direct. So the fact that we're down about $400 odd million year to date, again, the 5-6% gain that we have, I guess it's respectable. But if that ADT can actually pick up much higher, then we can actually see gains being tacked on a little bit more. And as I said, strong earnings growth and higher beta will probably tend to focus on sectors like brokers, materials, property, ports and logistics, and banks. And then with regards to this chart here, it's more of a technical chart, I suppose. You know, we've had a bad year last year, but every time a bad year comes, a good year tends to follow. The caveat behind this is that good year the next year never actually overshadows or compensates for what we lost. It'll take about 2, maybe even 3 years to do that, but at least it's a road to recovery. And so I want to end on that high note, and as we transition to the Q&A, we'll get our team to try and put our chairs and tables to address those questions and answer them later on.
All right, well, thank you, Ismail. So we'll jump in here, and if you do have questions, please type them into the chat. And I'll make one comment here. As you see, we're in our fairly new conference room and screen, and we've gotten some feedback that the slides were too small. Usually we insert them, so we'll have this webinar up on our website, including the slides on Friday. So if you do want to see the slides and the font wasn't big enough, we apologize. So let's go here to the questions, and there's a lot of questions, so that's terrific. Michael, we'll start with you. This is a very timely question. What is the impact, or is there impact, of OPEC production cut on Vietnam?
Okay, good question. So, you know, we're not oil economists, obviously, but it does seem like this production cut, you know, is going to put some upward pressure on oil prices. Let's say if we get a sustained move in oil price up something like 10% from where it was before the announcement. Right now, CPI inflation in Vietnam in March was around 3.3% year on year. I would think that probably within, call it around 4 or 5 months, we'd be back over 4% CPI inflation if the oil price were to stay at that level. One thing to mention, by the way, is that Vietnam has a small energy deficit. So basically, we produce crude oil and we export it, and then we re-import the refined products because we don't have enough refining capability, basically. So we're not in like a big oil deficit, basically. Yeah.
Cool. Question here for Ismail. Ismail, why do you think banks have done so well in terms of price performance? They certainly started the year very strong.
Yeah. The banks is probably going to be the most important sector, given that the weight is about 37.5% of the VNI. Back in 2022, the index was down 32, but the banks actually held up 21.5%. And for the first quarter this year, that continues, 12% up year to date. I think the reason behind that is the earnings outlook is still quite solid. There were concerns about the corporate bond issue maybe having a spillover effect in terms of asset quality, but the more we speak to the banks, the more we realize that it might not actually have that meaningful impact. That's one. The second one is in a rising rate environment, of which we had rate hikes in the latter part of last year, and then it got cut just recently. Higher interest rates bodes well for margins, and so the profitability is enhanced. So in that sense, you would tend to think that with the higher interest rates, the banks actually tend to benefit. So there's a reason behind it. The earnings outlook was actually quite solid. 2022 was about 35% year on year. This year, we're looking about 17 to 18%. And as I said, we're not coming off a low base, that's for sure. And it seems to be quite solid for a very big sector.
All right, so let's go to the other side of that. You know, we talk about one of the tremendous themes of Vietnam, long-term secular growth, emerging market, middle-class, domestic consumption. Having said that, the share price of consumer companies has actually lagged in a pretty meaningful way. You know, maybe comment on that.
Yeah. As you saw in the earlier slide, the consumer discretionaries, and also staples for that matter, have actually been the laggard this year. The reason behind that is as we speak to the companies, our bottom-up, boots-on-the-ground type assessment, a lot of the companies started to guide down. At the start of the year, they were looking at some robust number, but then companies like Mobile World, DigiWorld, PET, FRT, they all started looking at 20 to 30% lower number as far as revenues and sales was concerned. And the reason behind that is there's almost like a bifurcation, if I got that word right.
Not really.
Not really. With regards to the low and middle income class and the high-end class. And what's happening is those layoffs that we've been hearing in terms of factories or the short hours, it's impacting income. Now, that may not necessarily be hitting the middle part, but the sentiment is filtering through. And so people are a little bit more hesitant to make those big ticket items or even discretionary items. So what's happening is the sales of ICT, information and communication, electronic stuff, technology, it's actually down. And the only thing that we're seeing in terms of resiliency, if you want to call it that, despite weaker numbers, are the higher end. So things like jewelry, which is represented by P&J, or perhaps higher ends of autos or higher discretionary type of ticket items. Those are holding up better than actually the low to middle end. So it's an interesting difference between subsets of the income streams here in Vietnam.
I think some of the other things you and I had talked about in the past too is that obviously the sentiment in the real estate market is kind of weighing on people's, how enthusiastic they are to spend. And the other thing is I put on one of my slides that the retail sales growth is quite high, but part of that, don't forget, is because of the tourists coming back. If you strip that out, probably the spending by domestic consumers is growing maybe around 6%, something like that, which is not like falling off the cliff, but it's not, usually that number is growing at like 8-9%. So that's probably another part of the thing that's going on. Yeah.
All right, so you mentioned real estate, so we'll ask a follow-up question. So Antoine, thank you for your question. So you talked about, in Vietnam, there's more demand than supply. So the question here is related to affordable housing. The government just came out with a kind of a policy decree as well. So is affordable housing sought after in Vietnam? And then how would we define affordable housing in terms of pricing per unit? And I'm assuming that also probably differs if we look at cities like Ho Chi Minh and Hanoi versus satellite cities.
Okay, that's a great question. Our analysis really focuses more on housing that normal kind of middle class type people would buy. I mean, this is
affordable or affordable.
No, this would be probably like affordable plus or what we would call the mid tier.
I don't know if there's an affordable plus term by the way.
Yeah, so that would be something around. Call it around 1,500, 1,700 per square meter, something like that. And that would be typically in geographies that are maybe call it around 40 minutes from the CBD, something like that. So for that type of housing, what we observe is that it's still quite within the realm of affordability for normal. We do an analysis where we look at, for example, let's say someone who has been working as a kind of senior manager in a company as a head of accounting or something like that, and perhaps his partner is a secretary, something like that. So for them, this sort of emerging, hypothetical emerging middle class consumer, their mortgage payment for such an apartment is going to be something like a little bit less than 30% of their income. So that's within the realm of affordability. The thing that the government just announced on Monday, they're talking about build like I think 1 million of new housing units. This is more, the intention of this is more for factory workers, so that would be more that are located in the periphery of the industrial parks. And there, to be honest, I don't really know because it's not something we really track. There aren't really listed companies that are focused in that area. So.
Okay, well, I just got disconnected and reconnected, so the questions are gone. But hopefully, so if you have a question, I'm going to ask you, apologies, to retype it because I just got disconnected, but I do remember a few of them. One of them relates to infrastructure spend. So a question came in very recently that said, and you talked about it a bit, but maybe expand on it, which is, if the government doesn't do the increase in public spending or doesn't reach the infrastructure goals, what do you think your GDP forecast then becomes?
Yeah, that's a good point. What we saw in Q1 was that the increase in infrastructure spending was about almost 20%, right? And the other way I look at it is as a percentage of GDP. So last year, infrastructure spending was around 4% of GDP, and my revised forecast is that we would get to 5% of GDP. I do think they'll get that number because they'll take more actions as the year progresses, you know, to get us up there. So I don't really see that as having a major impact on the GDP growth. I'm more concerned about the slowdown, you know, what I mentioned several times, the slowdown in the demand for the made in Vietnam products. Yeah, that's the thing I'm really focused on.
All right. Here's a question for you, and Dan, thank you very much. So can you please touch on the valuation of the market and the portfolio relative to history?
Sure. So at 10 times PE, we're 2 standard deviation in terms of where we are. On a 10-year average, the PE is running around 16 times. So 2 standard deviations suggest it is indeed quite cheap. And
we're at 10 right now?
We're at 10, yeah. And so in that sense, I don't think there's much debate as to how low the PE is at the moment. The growth in offer, again, it's probably kind of middling in the sense that it's probably in line with what you see elsewhere in ASEAN. But certainly the value seems to be a stronger statement right now for Vietnam.
Yeah, and we've seen that. It's interesting. It touches with the, you know, foreign investors had largely been absent from Vietnam in 21 and 22 up until the last couple of months of the year. And then when we touched about 9 times PE at the end of November, all of a sudden, you know, a lot of foreign money came back in, and that was kind of the bottom of the market. So again, I guess our job, actually your job, is to predict the market. But, you know, without predicting the market, certainly, you know, there looks like a lot more upside than downside at this point.
Yeah, if I take a look at the brokers, they all have their index targets. A few of them have revised it down to maybe 1,100, but a lot of them are still hovering around the 1,250 level.
Yeah, and again, when we think of our portfolios, because Dan, your question was about, you know, valuation of portfolios, what we find in our active portfolios is we end up having valuations usually in line, sometimes lower, but growth rates significantly higher. I think, you know, when I look at our UCITS portfolio, we generally have PEs in line with the market with an average growth rate of around 30% higher, and we're going to own 25 companies versus, you know, the index at 400 roughly for the VNI. So, yeah, again. All right, another question is, and this is something that's come up, and I don't know if, Michael, you want to touch on this. You know, we've talked a lot about the market. We didn't spend as much time, frankly, on kind of the elephant in the room, which is the corporate bonds. And so what's your view on corporate bonds? Are there kind of upcoming maturity cliffs, and is the worst behind us, or is this going to be an anchor on kind of momentum, positive sentiment, and just behavior?
Sure. If you look at the bond repayment schedule, the bulk of that is going to happen in 2023 and 2024. 31% of what we estimate is out there will come due this year, and another 26% will come due next year. To put that in US dollar terms, that's $7.5 billion for 2023 and about $6.4 billion for 2024. Most of the exposure is still with the real estate developer. Again, this is public knowledge because I'm not saying anything that's a secret, but VTP accounts for about 14.5% of the total for this year, followed by Novaland, Masterized, Vingroup, and Sovico. So that's your top 5. Are we over the worst? In a way, we are, in the sense that Decree 8 was actually just introduced, and this allowed the payment schedules to be pushed out up to 2 years. There's also a new caveat behind that, that it allows also debt to asset swap, which, as I mentioned earlier, was not allowed before. That probably led to that relief rally that we saw, I think, a couple of weeks ago when this was introduced. And that's probably what led to the big surge that we found in March alone for the index. So yeah, maybe the worst is over. Having said that, we're still waiting with bated breath whether actually these things transpire, that it actually does provide some relief, because if this is just kicking it down the road, so to speak, the other part of the equation is the demand side. Yeah. And this goes back to Mike in the sense that the interest rate levels are still quite elevated. And so that's going to affect the demand equation.
So let's transition there. So Mike, some of the interest rates have been reduced, but if you actually look, bank term deposit rates have come down, but if you look at mortgage rates, have they come down enough?
Yeah, no, the interesting point here is that you can look at both sides. Like on the one hand, the deposit rates are sufficiently high that if you're someone who has a pile of cash and you're thinking where to put it, you probably think, hey, I could just put it in the bank instead of buying an apartment and getting yield. And then on the other side, as you said, if you're a home buyer, the mortgage rates, lending rates are linked to the deposit rates, so you're kind of priced out there. So that we really need to see we think about a 200 basis point further drop in the deposit rates in order for the real estate market to really get revived. The issue here, as we have talked many times before, is this liquidity in the banking sector. So the banks, credit growth outpaced deposit growth significantly for a couple of years now. So now we're starting to see some signs that some of that should reverse by the end of this year. The other issue in Vietnam is that because we're still an emerging market, a developed market, this mismatch between like the policy rates and the rates that the banks are paying, that would be, in other markets around the world, that would be solved by what people would call like a shadow banking system. Well, obviously we don't have that because we're too early for that kind of a thing. But that would be the thing that in other markets would make the link that would stop the deposit rates being so far stretched away from the policy rates. So.
And just to give some perspective, we're living here, I think sometimes we take this for granted when we say, oh, the interest rates are high. Let's actually explain how high the interest rates are at the banks. And so right now, I think the 6-month was just capped at 5.5%, down from 6. And most people, when they have money in the banks here, will do 3-month or 6-month term deposits. Some will do 12. 12 months is now around 8.5 on the higher end, correct?
Yeah, the average, I shouldn't say that, let's say the median, so we'd be fair, get the outliers. But the median has probably gone from a little bit over 8% to like a little bit under 8%, something like that.
And so when, we're looking at, I know rates have come up in the US and certainly some other markets, but we're still at 8%. And so for the banks, and so for the people that are saying, how can, Vietnam be lowering interest rates? It's frankly because
while inflation is around 3%, by the way.
Okay, so let's go to inflation.
Right.
Why is inflation so low here? Because when you look at the rest of the world, when you look at even the rest of Asia, we're outliers.
Yeah, that's a really good question. So inflation in most countries around the world, kind of the core issue is that during the COVID time, governments around the world, particularly obviously in the US and Europe, borrowed a lot of money and kind of essentially printed up a bunch of money and gave it out to their citizens. Even in the rest of Asia, that was happening to some extent. We talked about before that Indonesia had its first experiment with quantitative easing, which was kind of amazing in our careers. We've never seen anything like that before. But the key issue in Vietnam is that they didn't spend a lot on COVID. They didn't need to because the economy is fundamentally strong. So that's one thing, is that there's no kind of fiscal overhang here. Last year, the government actually ran a budget surplus, which is incredible. So that's one thing. And the other thing is that one of the drivers of inflation in Vietnam is often food price. So food is about almost 40% of the CPI basket. And what we've seen is that with the China reopening, despite the reopening, food price inflation in China has stayed relatively muted. That's partially because of some issues having to do with African swine fever. Pork prices are falling, et cetera, et cetera. So lack of food price inflation, lack of a robust reopening boom in China are also factors that have helped to keep inflation low in Vietnam.
Okay, you're giving me excellent segues. Thank you. Oh. So China reopening boom, we had a question on that, which is, has it been what we expected? And I think one of the things we always talk about is China has a huge impact in Vietnam, but oftentimes differently than the way people think about it. It's not a big buyer of our goods.
That's right.
But it's actually hugely important for tourism.
Right.
So how has the reopening, I don't want to say boom, how has the reopening impacted Vietnam?
This is a great question because there have been a lot of articles in the Wall Street Journal and other places saying, hey, this China reopening boom we're expecting is not as much of a boom as what we had anticipated. And so therefore it's understandable that people are kind of asking us, well, wait a second, is that one of the things why the GDP growth is weak in Q1? And actually the answer might be surprising, but no, it's not a factor. When you look at the trade that happens between China and Vietnam, 2/3 of the trade is basically in the garments supply chain and also in the electronics supply chain. And it's sort of two-way trade back and forth across the border. We actually run a very substantial trade deficit with China, almost 20% of Vietnam's GDP. So actually the way that it works between China, Vietnam, and the US is that We import production materials from China. That can include factory equipment, automation equipment, this kind of stuff, or plastic resins, things like that. So we import that. We have a big trade deficit with China. Then we make the products here and we send them off to the US. So it's almost in a way like we're kind of a customer of China and then the US is like our customer. So when you think about it as a store, like when you're, when you're the customer and it doesn't end up hurting us as much.
In the tourism piece from China?
Well, there's been a bit of recovery in Chinese tourists, but there's some visa issues there, so it's not substantial at all. Most of the tourists that are coming back so far is from Korea, which is not surprising, and we get some from the US and Europe. What we think will happen is once those, because China used to be 1/3 of the tourist arrivals before all the COVID stuff. So that's why we think like as the year progresses, we'll get a stronger and stronger boost from Chinese tourists coming back. But so far, they're not really coming back that en masse.
Right.
Yeah.
But as a reminder, for those of you that have been to Vietnam or even visited our company, we're on Wood Huay Street, which is the main walking street here in Ho Chi Minh City. And I've now only been here for 3 years, but there's more tourists here now than there have been, certainly. Yeah. It's more than noticeable every single day. All right, here's a question for you, which is, I think it's for you. A question came in, which is, how is what's going on in Vietnam kind of different from previous financial crisis or previous crisis in Vietnam? And I would even say, is this a financial crisis or is it a liquidity? Like, it's very specific.
Yeah, I don't think this is a financial crisis at all.
But the market was down 33%, so someone might disagree.
Yeah, that was more about the uncertainty created by, if I had to categorize it, some event stuff. And it's the anti-corruption campaign. Vietnam was doing fantastically well. It had hit a high of about 1,500 plus sometime in April. And then the first arrest came through. And then that actually drove the market down, pretty much 19% dip, if you recall, in the second quarter 2022. Yeah. Third quarter, we've kind of found our footing a little bit, but then by the time October came around, the new set of arrests came through. Yeah. And so again, it's all these shocks to the system that's coming through. Those actual financial crises would be 2008, 2012, and that involved the banking sector, where high NPLs, you can say even a property bubble, if you want to call it that, was actually the key issue. And again, two big sectors that were affected in a meaningful manner, in a real way. And these things are all about the uncertainty that was created by those arrests and investigations.
So there were, in a sense, there were some structural issues in the before. There were kind of actual crises where you needed legitimate policy intervention. Mm-hmm. Here, there was.
Yeah, this was so I was actually here during that time. I was the CIO at a small fund, and I remember back in 2008. I'll give you really short. There were two things happening in 2008, 2009. One was that the Vietnamese government looked at what was happening with the GFC, and like China, they were kind of very concerned about the impact that would have on the economy here. They launched a subsidized lending program at that time. So basically what the government did is they went to the banks and they said, okay, when companies borrow money, whatever the interest rate you charge them, we're going to give you I think it was about 5%. It was a big subsidy, right? So that was only supposed to be for borrowing to pay the payroll or whatever. Not surprisingly, companies went out and borrowed enormous amounts of money, put it in the stock market, that kind of thing. So that was one problem at that time. And the other problem at that time, and this is really important, is that there was enormous cross-shareholdings. You had real estate companies that were buying banks so they could lend back to themselves. None of that is possible anymore. They've cleaned up all that stuff. So we're in a much better shape now than back then.
No, and it's a great question because there's a cliche from one of my former colleagues, which is history doesn't repeat itself, but it rhymes. And I think when we see these different crises, we get to learn from other events in the developed world or other events here in Vietnam. And again, it's always a different crisis, but this one probably is smaller.
Yeah, it's smaller, and also because they've addressed a lot of those structural issues. It's a much more solid foundation now, I think. So
I think cross-holdings even exist at this point in time. If I look at the banks, there's one tiny one example.
All right, and Michael, this is for you. Let me see here. What is it? Because please share your thoughts on the ample forex reserve and how it can be utilized.
Okay, that's a really good question. It's interesting. This question came up from somebody yesterday. So first of all, Normally, for emerging market countries, or maybe just for countries in general in the world, we think like you should have 3 months worth of imports, or maybe 4 months worth of imports of FX reserves put aside. And one of the things we were talking about last night, actually, is that that rule, that benchmark, okay, it's a good idea, but in Vietnam, where the imports are so humongous, that becomes kind of a difficult threshold to keep. The IMF has a metric that they call ARA, Assessing Reserve Adequacy, which is kind of a more sophisticated way of looking at the reserves. Right now, we're probably about 10 to 15% below what the IMF's recommendation is. So I actually wouldn't say that the reserves are abundant. I think we do have some more work to do to rebuild the reserves that we used last year to support the dong. So far in Q1, I think they bought maybe about $5 billion of FX reserves, and we think by the end of the year they'll probably buy another 20 billion or so. And that will get us back up to kind of the in line with what's the recommended level.
All right, cool. And Ismail, here's a question for you from Derek, which is, what are the top 3 sectors for long-term investments in your view, and what are the respective market risks for each of them?
Yeah, the easy one is going to be consumer, in the sense that 2/3 of GDP is still consumption. There is, of course, going to be cyclical in that sense. And at the moment, that cyclicality is actually hitting down because of those impacted incomes and also the wealth effect that Mike alluded to from the real estate market. So, but consumer here, the secular trend of modern retail is something that should feed through to a lot of these companies. That's one. The second one is actually the banking sector. The banks here are still enjoying very, very fat margins. They're up there with Indonesia. I'm trying to figure out who's got the highest one, either Vietnam or Indonesia. And in every bank around the world, the key drivers for profitability is always going to be margins and, of course, credit costs. The credit costs is now being addressed in the sense that you're not going to expect that big blow up. And part of the reason behind that is the credit quotas. The central bank here has implemented a quota for each year, anywhere from 13 to 15%. And if you think about past crises from Argentina, Mexico, Russia, Thailand, they all grew 30+%, of which, of course, Vietnam saw that in the past. That's not going to happen anymore. The trade-off behind that is a very steady GDP of 6 to 7%. So the long answer, or the short answer to all this, is credit cost is not going to be a factor, so banks is another one. And then finally, the third one, we do like anything related to real estate, despite what's happening now. As Mike alluded to in one of these slides, there's so much pent-up demand for households. The household formation is still coming through. And if I extend this to the industrial parks, again, it's not, the mini China might be an exaggeration, but there's going to be that continuing trend of people looking for factory relocation. So I think those 3 sectors are the one we want to look at.
And I think culturally, we all recognize that there's an innate demand for real estate here in Vietnam. It's just kind of everybody's first investment is real estate. So that brings us, we've been doing this for, I guess, an hour and 2 minutes. I want to be sensitive to everybody's time. I do know there were a couple of questions that we didn't get to, so we'll try to get those, or you can email me directly. But again, thank you very much for joining us. We'll look forward to seeing you in July for what will be our Q2 review and our Q3 outlook. And then importantly, just as a reminder, our investor conference dates are now confirmed, October 2nd through 4th, later this year here in Ho Chi Minh City. We'll start with a reception on Monday night, the 2nd. We'll do the meetings on Tuesday and Wednesday. If you're able to make it, please plan ahead. It'd be great to be able to host you live here in Ho Chi Minh City. With that, Ismail, Michael, thank you so much. And if there's any questions, please let us know. Thank you again.